The world of global finance is built on trust. For decades, nations parked their wealth in dollars and euros, believing it was safe, beyond the reach of politics. But on December 18, 2025, that trust was shattered. The EU's decision to seize profits from frozen Russian assets sent shockwaves worldwide, a financial earthquake, not just a political move. Suddenly, the foundation of the international monetary system is trembling. For over a year, Brussels debated. Should they redirect Russian interest to Ukraine? Some called it a moral imperative. Others warned it would destroy the West's financial credibility. The line was crossed. The consequences are now unfolding in real time. Russia's response, once dismissed as bluster, has proven swift and severe. European corporations with billions in Russia now find their assets frozen, dividends blocked, futures uncertain. The move meant to punish the Kremlin is inflicting deep pain on Europe's own industrial giants. The tremors extend far beyond Europe and Russia. In finance ministries worldwide, a quiet but urgent reassessment is underway. The question, is our money safe? If Russian assets can be seized, what about ours? The safe haven status of the dollar and euro is now openly questioned. This single act may have accelerated a global shift away from Western-dominated finance, redefining power for generations. The world is watching and holding its breath. In February 2022, the West froze $300 billion in Russian central bank assets, over $200 billion in Europe, mostly at Euroclear. The move was meant to cripple Russia's war machine, but the principle remained Russian property, simply immobilized. As interest rates rose, the profits on these assets became substantial, billions annually. European leaders, under pressure to fund Ukraine, saw temptation, use the profits, not the principle. It was pitched as a clever compromise. Help Ukraine, avoid fully breaking the taboo of sovereign asset seizure. By mid-2024, the debate peaked. The US pushed for more. France and Germany hesitated, fearing for the euro's reputation. Ultimately, Europe seized only the interest. Legislation passed, funds transferred, but the message to the world was clear. Sovereign assets in the West are not inviolable. The distinction between seizing interest and principle was lost on many. The European Central Bank warned of long-term damage to the euro's global role. Those warnings were ignored under political pressure. The stage was set for confrontation. The world saw a Rubicon crossed. Trust in Western financial neutrality was broken. The consequences would be dramatic and costly. Moscow had warned, seize our assets and we'll retaliate. Many in the West dismissed this as empty threats, but Russia had prepared, mapping out Western economic interests within its borders. When the EU acted, Russia responded with targeted capital controls and asset freezes on companies from unfriendly nations. Major European corporations, automakers, energy giants, banks suddenly couldn't repatriate profits. Dividends were blocked, exits taxed, and sales required near impossible presidential approval. Billions in European assets were stranded, stock prices plummeted, projects were abandoned, and assets nationalized. Moscow's message, target our state assets, will target your private ones. The EU's unity began to crack as corporate leaders demanded relief. The real-world costs hit home, not in government coffers, but on corporate balance sheets. European corporations are caught in a geopolitical vice, squeezed by their own governments and the Kremlin. Years of investment in Russia have turned into liabilities, assets frozen value evaporating. Boards face agonizing choices: wait and hope or exit at a loss. Many are effectively hostages, their businesses pawns in a larger game. The uncertainty paralyzes investment and spooks shareholders. Political blowback as fierce CEOs question policies that hurt their own companies more than Russia. A rift grows between political leaders and business leaders desperate to save their firms. The crisis forces a rethink. Political risk now trumps global expansion. The era of frictionless globalization is over. Behind the corporate drama, a bigger shift is underway in central banking. The EU's move confirmed the worst fears of non-Western nations. Sovereign immunity is no longer sacred. Quietly, central banks are reducing euro and dollar holdings, repatriating gold, and de-risking. This isn't panic, it's a deliberate, long-term strategy. The gold-built financial fortress is immune to Western sanctions. Data shows global reserves in euros are dropping, gold allocations rising. Nations are hedging, moving towards self-reliance and regional currencies. New payment systems and digital currencies are being built to bypass SWIFT. The world is fracturing into parallel financial systems. Efficiency is sacrificed for safety and sovereignty. The search for alternatives to the dollar and euro is reshaping global finance. Central bank gold purchases are at record highs. China, India, Turkey, and Poland lead the way. Gold, immune to political seizure, is back in favor. Alternative currencies are rising. The Chinese yuan is gaining traction in global trade. Russia and China now settle most energy trade in yuan and rubles. Brazil and China trade in local currencies. Saudi Arabia eyes yuan for oil. New payment systems, Russia's SPFS, China's CIPS, are growing, challenging SWIFT. Central bank digital currencies could accelerate this shift, enabling direct cross-border transactions. The post-W1T dollar-centric order is fragmenting. Multiple reserve currencies and payment systems are merging. For many, the price of complexity is worth the gain in sovereignty. The global energy market is a casualty of this financial realignment. The petrodollar system, which made the dollar king, is fading. The weaponization of finance ended that era. Russia now sells energy to China in yuan and rubles, to India in rupees and dirhams. A parallel energy market outside the Western system is growing. OPEC Plus producers diversify, accepting more currencies for oil. The exclusive oil-dollar link is weakening, a seismic shift. The world splits into two energy blocks, one dollar-based, one Eurasian. Price discrepancies and volatility rise. Europe pays more for energy. The rewiring of energy flows will shape geopolitics for decades. Was it worth it? That's the question haunting Europe's leaders. The moral case for seizing Russian profits was strong: support Ukraine, punish aggression. But the strategic and financial costs are staggering. The West's reputation for neutrality and rule of law is damaged. Billions gained for Ukraine may be dwarfed by trillions lost in trust and capital flight. Europe, with more to lose than the US, bears the brunt of retaliation and division. The policy meant to show unity has created new fissures and pushed rivals closer together. The decision to cross the financial Rubicon has changed the world, accelerating the shift to a fragmented, multipolar order. The rules of the global game have changed forever.